All right, let's dive straight into a pretty interesting corner of the financial world today.
Yeah,
We're looking at a practice called marking the close. We've been digging into some material from FinCrime intelligence, and it really lays out what this is all about.
that's right. And our goal here for this deep dive is really to unpack that. Using this source, we want to understand what marking the close actually is, how it works, why it matters so much.
The motivations behind it too, right? And
Yeah.
the rules, the regulations against it.
Exactly. And importantly, how it's being spotted and, hopefully stopped.
And for you listening, getting a grip on these sometimes subtle types of market manipulation, it's pretty crucial. It helps you appreciate, the whole idea of market integrity in today's, well, complex financial system. Let's
Yeah.
get into it.
Okay. So the FinCrime intelligence material, it defines marking the close quite clearly. Fundamentally, it's a trading practice, one designed specifically to manipulate the price of a security or an asset.
Okay, manipulate how exactly?
Yeah.
Because the source isn't just saying trading, right? It points to a very specific action.
It does. It's about executing a large volume of trades right at the very end of the trading day, specifically at or, very near the market's closing price.
Ah, okay. So the timing and volume are key.
Precisely. The aim isn't just regular trading, it's about forcing that final price point to where the manipulator wants it. And the source is really clear on this. This isn't seen as legitimate trading activity.
Yeah.
It's unethical, and it's definitely something regulators and law enforcement are focused on.
So let's drill down into the how. How does this actually get executed? What do the mechanics look like according to the source?
Well, it highlights the timing usually in the last few minutes of the trading session, the final 10, 5, maybe even just the last couple of minutes before
That
closing.
really narrow window.
Yeah.
Sometimes liquidity can dry up a bit then too.
Exactly. And the source sort of implies that's part of the strategy. Manipulators will execute a much higher volume of trades than usual during this period.
Okay.
So they'll buy aggressively if they want the price to end higher, or they'll sell aggressively if they want it pushed down into the close.
And they're doing this purely to influence that final number,
Yeah.
not because they have some underlying investment thesis about the stock at that moment.
That's the core insight from the material, yes.
Yeah.
They're essentially creating artificial demand or artificial supply pressure right before the market closes for the day. It's all about the impact on the closing price itself.
Not about a long-term view.
No, not necessarily.
That makes the next point really critical then.
Right.
Why is that closing price so significant? Why would someone risk engaging in manipulation just for that one number?
Yeah, that's a great question. The material lays out several really powerful reasons. One big one is its role as a valuation benchmark.
Benchmark, you mean like,
Like the official price used to value investment portfolios, mutual funds, ETFs, market indices at the end of the day or month or quarter.
okay, so it's the number that goes on the report card, basically.
You could say that, yeah. And naturally, it heavily influences investor perception. A fund closing strong looks good.
Right.
A weak close might raise questions.
Right.
And beyond perception, it actually determines settlement values. This is crucial for things like derivatives options, futures, or structured products. Their final payout might be directly linked to the closing price of whatever they're based on.
And I guess that specific price level could trigger other automatic actions in the market too.
Absolutely. The source notes it can trigger stop loss orders, those automatic sell orders if a price dips too low. Or it could activate certain algorithmic trading strategies that are programmed to react to specific closing prices.
Wow.
So, yeah, that single price point has quite a few ripple effects.
Okay, so the stakes are high for that closing number,
Uh-huh.
which explains the temptation, I suppose.
Yeah.
So what does the source say are the main reasons people try this? What are the motivations?
The material lists several. A really common one, especially see this around month end or quarter end, is boosting performance metrics.
Ah, like portfolio managers wanting their numbers to look better.
Exactly. Making their holdings look good on paper before reporting. It's sometimes called portfolio pumping.
Okay, trying to inflate the stats. What else?
Another big driver is influencing benchmarks for other purposes. So if a trader or a firm has positions in, say, options or swaps or futures contracts that settle based on a closing price, well, manipulating that price can directly mean making money or avoiding losses on those separate derivative positions.
Right, so it's not just vanity metrics. It's potentially real P&L on other bets tied to that close.
Correct. The source also mentions trying to mislead counterparties or other investors. This tactic is often seen in less liquid or thinly traded stocks.
Where it's easier to move the price.
Precisely. A smaller volume of manipulative trades can have a bigger impact, maybe letting them sell positions at artificially high prices or buy them low.
Taking advantage of that thin market makes sense.
Yeah. And finally, it could be about creating favorable conditions for other things, like impacting margin calls, which depend on asset values, or maybe loan agreements, or even regulatory capital requirements that are assessed based on valuations at certain times.
And the source points out this isn't always a standalone tactic.
No, that's a key point. It highlights that marking the close can be, and often is, used alongside other manipulative strategies,
Right.
like spoofing, placing orders you never intend to execute, or wash trading, where you're basically trading with yourself to create fake volume. Combining these can maximize the overall manipulative effect.
Okay, this definitely sounds like serious market abuse.
Hmm.
How do regulators actually view this? What's the legal standpoint?
Oh, they view it very seriously. It's classified pretty squarely as market abuse or manipulation. No ambiguity there.
And are there specific rules or laws mentioned in the source that target this kind of behavior?
Yes, absolutely. The material references key regulations globally. You've got the Market Abuse Regulation, or MAR, in the EU. In the US, there's the Foundational Securities Exchange Act, Rule 10b-5, which targets fraud. The UK's Financial Conduct Authority, FCA, has rules against it, seeing it as a breach of market conduct.
So broad agreement, it's wrong.
And it also goes against the principles set out by IOSCO, the international body for securities regulators concerning fair and efficient markets.
So it's pretty much universally considered misconduct. What actually happens if a firm or an individual trader gets caught doing this?
The consequences can be pretty severe. We're talking potentially large fines and also disgorgement of profits, meaning they have to give back any money they made from the manipulation.
Ouch.
Plus, there can be serious regulatory sanctions, things like being banned from trading or even working in the industry. In really blatant cases, especially involving intentional fraud, it can lead to criminal prosecution.
Wow.
And of course, the reputational damage for a firm caught doing this can be catastrophic.
Does the source give any examples, like typical scenarios where this has actually led to enforcement?
It mentions that historically, yeah, many cases have involved asset managers or maybe proprietary trading desks, firms trading their own money.
Right.
And the manipulation often targets securities that are illiquid or maybe small cap stocks, which makes sense because, it takes low volume to push the price around there.
Easier target.
Exactly. And interestingly, these enforcement actions often relate to trading activity right around month-end reporting dates, which lines up perfectly with that motivation of boosting performance numbers or influencing valuations we talked about.
Okay, so we know why people do it, and we know it's illegal with serious consequences. How do exchanges and regulators actually catch it? It seems like it could be subtle, happening just those last few minutes. What are the detection methods?
Yeah, that's where technology and data analysis really come into play.
Okay.
The source details how sophisticated market surveillance systems are the main tool here.
Okay.
These systems are specifically designed to monitor trading patterns, especially as the market gets close to the end of the day.
So they're watching that specific window extra closely.
They are. They analyze things like volume and price spikes just before the close, and they compare that activity to what's normal historically for that particular stock at that time of day. Is this sudden burst of trading usual, or does it stick out?
Makes sense. What else?
They also calculate things like trade-to-close ratios, basically looking at what percentage of a stock's total daily volume happened in those final minutes. If that ratio is abnormally high, it's a red flag.
And is it just looking at one stop in isolation, or do they connect the dots?
They definitely try to connect the dots. The source mentions analyzing cross-security correlation, meaning are they seeing similar suspicious patterns happening at the same time across, say, a whole basket of related stocks, or maybe across the different stocks that make up a specific index that could suggest a more coordinated manipulative effort.
That sounds like it needs pretty advanced systems.
It really does. The material specifically mentions the use of behavioral analytics, often incorporating AI or machine learning. These systems try to learn what normal trading looks like for specific traders or firms, and then they can flag deviations or patterns that suggest repeated misconduct or, potentially manipulative intent. Surveillance teams are definitely keyed into this end-of-period activity. That's prime time for attempts to distort settlement prices, fund values, or performance fees.
So that's detection. What about prevention? How do firms try to stop this from happening in the first place? What kind of internal controls should they have?
Right, prevention is key too. The source emphasizes that market participants, especially brokers and asset managers, need robust measures. This can include things like pre-trade approval processes.
Like a second pair of eyes.
Exactly, particularly for large or aggressive orders placed near the end of the day, and especially if it's in a security that doesn't trade much, or manipulation is easier.
Okay, so a check before the trade goes through.
Yes. Firms also need effective trade surveillance alerts set up within their own systems. These should flag those volume or price anomalies near the close automatically.
Technology helps there too.
It does, but it's not just tech. The source stresses the importance of code of conduct training, making sure traders understand what's acceptable, what's not, and fostering an ethical culture.
Right, the human element.
Absolutely. Compliance teams should also be doing regular reviews of trader activity, paying special attention during those high-risk periods like reporting cutoffs or NAV calculation points.
And if an alert does go off, if the system flags something.
Then there needs to be clear escalation protocols, a defined process for investigating those automated alerts and deciding what action, if any, needs to be taken.
The source also mentioned some environments being higher risk, didn't it?
It did, yes. It specifically points to proprietary trading environments where firms are risking their own capital and also places with strong performance-based incentive structures.
Ah, where bonuses are tied directly to performance.
Exactly. When your pay packet is directly linked to short-term results, the temptation to bend the rules with something like marking the close to boost those numbers just gets higher. So controls need to be extra tight in those situations.
So let's pull this all together. Looking at the big picture, why is tackling this specific practice, marking the close, why is it so important for the market overall? What's the strategic significance?
Well, the material puts it quite starkly. Marking the close fundamentally undermines market confidence. Simple as that. It messes with price discovery, the whole process of figuring out what assets are truly worth.
And disadvantages regular investors.
Absolutely. It disadvantages uninformed investors who trust that the closing prices they see are fair and accurate, and who use them to make decisions.
And you could argue that in today's markets, with everything so fast and automated, that closing prices may be even more critical than it used to be.
I think that's fair to say yes. In a world driven by algorithms and high-frequency trading, the accuracy and, importantly, the fairness of closing prices are vital. A manipulated close can send bad signals rippling through indices, funds, automated strategies. The impact cascades.
So preventing this kind of abuse, it's not just about punishing rule breakers. It has wider benefits.
Exactly. It directly supports investor protection. It ensures that the performance of indices, which so many investment products rely on, is credible. It promotes fair asset valuation across the financial system. And ultimately, it shores up overall market integrity.
Which is crucial for everyone.
Absolutely. And the source sort of concludes on that note, stressing that financial firms, regulators, the exchanges themselves, they all need to stay vigilant and keep adapting to prevent this subtle but damaging practice, as they call it.
Wow, okay. That was a really comprehensive look at marking the close, pulling directly from that FinCrime intelligence material we've covered. What it is, how it's done.
The mechanics, yeah.
Why that closing price is such a big deal, the motivations, the rules against it, and importantly, the detection and prevention efforts.
Yeah, it paints a pretty clear picture of one specific way markets can be vulnerable and also the layers of defense that are built up to try and protect that integrity.
It really does. And it leaves us with a thought, kind of stemming from everything we've just discussed based on the source. We've talked about sophisticated surveillance, tough regulations. But trading itself is also incredibly high-tech and always evolving. And those performance pressures aren't going away.
Right. The cat and mouse game.
Exactly.
Yeah.
So how might that game continue? As the current methods for marking the close get harder to pull off, what new, perhaps even more subtle tactics might emerge to try and influence those crucial end-of-day prices? Something for all of us, especially you listening, to think about as the markets continue to change.